Hey guys, this is your girl Paula, the queen from Queens. These are money minutes that matter. Today, we're going to go into the intricate world of bonds, not James Bond, the intricate world of financial bonds. These are financial instruments like stocks. I know before we talked about mutual funds. If you don't remember, go back to my previous video about mutual funds. These are financial instruments with many forms and functions. So, fasten your seatbelt. We're going to embark on a serious journey. Let's go. So, let's talk about bonds. At the forefront of our exploration of today, we're going to talk about corporate bonds. This is like the financial backbone of corporate America. It's where they seek capital for their growth. When you buy and invest in corporate bonds, you're essentially becoming a creditor to these companies. It could be a 5 or a 10-year bond. Well, once the time is reached, which is called the maturity, you get the amount of money that you invested, plus you get interest, whether it's quarterly, semi-annually, or annually. Let's just say you want to buy a 5-year corporate bond for $5,000, which at its present value, your $5,000, which is your initial investment, it's your money, and the interest rate is, let's say, 10%, which is giving you quarterly earnings. That means $5,000 times 10% equals $500 per year of annual interest, which will be paid out quarterly, which is every 3 months at $125 per payment. Your future value will be $7,500. Your $5,000 investment plus the $500 you receive each year for 5 years. You're their bank. You're lending money to that company in exchange for interest payments and the future of your money, which is the principal, back at maturity, which is the time you have agreed that the loan will be over. These bonds, they vary in risk, with higher rated ones considered safer investments. There's AAA ratings, there's BBB ratings, there's A, small a, there's all kind of ratings. It's a confusing interest market. The picture is like a dynamic dance between risk and rewards. The higher the risk, the higher the potential reward. This is where investors support the companies. From blue chip giants to emerging startups, corporate bonds offer a diverse market for investing. Treasury bonds, or sometimes they're called T-bonds. These are also long-term securities because the maturity may be as long as 30 years. These are the bedrocks to the government. It covers the government's debt. When you invest in a treasury bond, you're essentially lending money to the government. It could be to a federal or a local government. The government has bills. They have debt that they need to pay. So we, the people, can lend our money to our government. And as we lend them their money, they pay us back on a semi-annual interest rate payment system. These bonds are considered one of the safest investments, and they're backed by the full faith and credit of the United States government. While returns may be a little lower compared to the riskier corporate bonds, T-bonds provide a safe haven for investors seeking stability in their portfolio. This may be a good potential investment vehicle for those of us who are looking at retirement or people who may already be retired. As I tell my clients, if you need your money within the next 5 years, do not have your money invested in risky markets. Government bonds may be safer for you. They're not just financial instruments. These are pillars to our nation. It gives us capital to the United States government and to local markets, and it helps them to weather storms. The interesting thing about T-bonds is you do not pay any state or local income tax. You only pay federal income tax. That's also a savings. Think about that. You're gaining money while you're also saving money. Understanding the intricate mechanisms of T-bonds empowers investors to navigate the nuances to the world of government debt. Let's venture into the community-driven landscape where we encounter mutual bonds. These financial instruments fund the projects in our local communities. When you invest in a mutual bond, you're not just giving passive money. No, you're being an active investor. You're contributing to the growth of your community. These bonds are issued by municipalities, cities, and states. They play a crucial role in financing projects like schools, hospitals, and local infrastructure. Investors not only earn interest, but we also play an active role in developing the areas that are important to us. It's a symbiotic relationship where finances are paid to you, but also you're investing in the progress of your community. What's important to you? Put your money where your mouth is. Agency bonds are a dynamic fusion of government-backed and private initiatives. These bonds are issued by government-sponsored enterprises called the GSES, government-sponsored enterprises like Fannie Mae and Freddie Mac. Investors in agency bonds receive higher interest rates compared to Treasury bonds because they are slightly higher risk. Remember, the higher the risk, the higher the potential for return. It's a dance between the safety net of the government support and the dynamics of the private sector. Agency bonds offers investors a chance to diversify their bond portfolio. Remember, diversification equals a variety. All of your eggs are not in one basket. Navigating the intricate balance between risk and rewards. Risk, rewards from either one. The higher the risk with the private sector, the lower the risk with the federal bonds. This is a combination of the both. Let's look at a few other bonds. We have what's called international bonds. These bonds provide diversification in our portfolios as well, and they expose us to a different type of economy. But there are also currency risks and geopolitical factors. Bond exchange trade funds provide a diversified portfolio of bonds within a single investment. These ETFs offer investors an exposure to different sectors, maturities, and risk levels. It's a strategic tool for those seeking broad diversification as well as liquidity in the bond fund without committing to individual bonds. Meaning, some of the bonds may mature faster, some may have a higher yield. There's security and liquidity, so you have safety as well as you have finances. Finally, let's talk about green bonds. These financial instruments are focused on sustainability. We all want a greener world. These bonds often hail as a catalyst for positive change. These funds fund projects for environmental benefits such as renewable energy or eco-friendly infrastructure. Investors contribute to positive environmental impacts. What do you want for your future of your family? Global warming is real. Whatever's going on today will affect our children and our future. We have to prepare for them now. There you have it, a detailed exploration into the diverse world of bonds. Whether you're navigating the intricate landscape of corporate bonds, seeking the stability of government-backed treasury bonds, or contributing to your community through municipal bonds, or even looking at how can we better our world by green resource bonds. Each of them offer a unique avenue to invest your money while helping others to do something positive. This is your girl Paula. I am here for you. If you like what you're hearing, click subscribe, like my channel, go on my website, robertstargetfinancials.com. If there's any issue financially that you want to talk about, I am here for you. Just drop it in the chat. I love you. Have an amazing day.